Hi, everyone. It feels awkward that I can't see you, but I'm going to assume you're really there. So thank you, Twin. I realized there was some need for people being taken care of when I was a child growing up in Los Altos and was riding my bike down one of the new streets there. And this old man was shuffling down the middle of the street. He had a dark suit on and fluffy slippers. And when I got near him, he said, "Do you know who I am? Do you know where I live?" And I didn't. It freaked me out. And I circled back to long-term care decades after that. But I consider it my passion, and I don't want that to happen to anyone else, including any of you out there. So the purpose of this talk is to give you enough information so that you can think about how you plan to pay for care in the future, and also if long-term care is something that might make sense. So first of all, what is long-term care? We're not talking about insurance right now. We're just talking about what is long-term care. It's basically care provided to someone that can't live independently anymore and they're not in a hospital situation. And it could be because they have severe cognitive impairment, which would be Alzheimer's or the like, or they need assistance with daily activities like bathing, dressing, toileting, things like that. And they really can't live independently without it. Now, the risk does increase as we age, but it could happen at any age. My youngest client needed long-term care when he was in his early 30s, and he spent the rest of his life in a skilled nursing facility, which was about a decade. Most long-term care is custodial care. That's very important, the difference between custodial and skilled care. So most long-term care is custodial care. It means it's not medical attention. You don't need a nurse or an aide to be there medically for you. You need a caregiver to be there to help you. Also, long-term care is not synonymous with nursing home care. This is a mistake a lot of people think when we discuss insurance. They say, "I don't ever want to go to a nursing home." So it's not synonymous, and we'll go into that a little bit more. And government statistics reflect that 70% of people 65 and older will need some amount of long-term care services before they die. That could be 2 weeks, it could be 20 years. It's just that 70% will need something. Basically, if you live long enough, you're going to need help. So where is long-term care received, and what does it cost? First of all, let's look at care at home. Most people tell me they want to stay home and receive benefit in their own home. And in their home, they might need custodial care. Remember, that's the non-medical care, or they might need skilled care. They also might need something what we call personal care. That is basically the germ of custodial care is personal care. Also, homemaker services, someone to keep their house up, do the shopping, cleaning, cooking. Adult daycare, when they go out to a daycare facility, which is also great for them to socialize as it is for their family. They have one there to get a break. And hospice care, which is when they're terminally ill. All of that would be available to you when you're at home. So if you've been thinking about this and thinking about your home, and maybe you're getting older or you see your parents, you need to think about how you remodel for mobility and safety. Most of our homes are not adapted for people who will have issues with mobility. Also, who's going to care for you? How do you feel about a family member or a friend caring for you, being a primary caregiver for you? Might that be a burden to them over time? Will they have to stop working, stop caring for their own kids, what have you? And where will the additional cash flow come from to actually pay for paid care? This is a current rate sheet from a local home healthcare agency. And just take a minute or a second here to look at what those rates are. They range between $38 and $45 an hour. If you need around-the-clock care through an agency, you could be paying as much as $1,000 a day. Mostly, though, I would say probably closer to $25,000 a month. Most people don't receive 24/7 home care. It's just a little bit too challenging. Usually you have a family member and they need care for several hours during the day. or they may go on to another option for care if it gets to the point where they're a shut-in and they're alone with a caregiver. So the next place where we can receive long-term care is a facility. And there are multiple types of facilities. This page, though, shows you the ones that are not skilled nursing care. These are the facilities that provide custodial care. You might have heard the name assisted living or residential care or memory facility. A memory facility could also be a wing of a residential or assisted living facility. And also we have board and cares, which are homes that take in a number of people and care for them. So at these types of places, they have 24/7 custodial care only. There aren't skilled people there. It'd be very rare that there would be a nurse on premises, maybe some of the bigger residential care facilities. Meals and housekeeping is provided and medications administered. So they have activities. That's one of the reasons that a person might want to leave home and go to a facility like a nice assisted living or residential care, because there's activities and there's other people around, so they're not isolated. If people are concerned about the lack of a social life, isolation, and safety in their home, it's really a good mix for them. They'll have their own room or apartment, but they have comforts of an active and supportive community. Some of the facilities also have people who might move in while they're still independent, or they don't need care, but they just want to age in place in a facility. Or maybe their spouse needs care and they move in together. And that can be very comforting as well. The monthly costs of facilities does vary tremendously. By the way, all the rates that I'm showing and talking to you about relate to the Bay Area. I'm in San Francisco, but the Bay Area, the peninsula is very, very similar. East Bay might be a little bit less. So monthly costs in facilities vary, and oftentimes the fee is divided into two parts. One part is just the room and board. So you might go somewhere and the room and board is $4,000. And then there's another charge for monthly care. So obviously, if you went to a facility, you didn't need care, but you just want to buy into their meal program, or your spouse was there and what have you, you wouldn't do the monthly care cost. If you need care, that's when you start to pay more. And monthly care could be anywhere from under $1,000 a month to $8,000 a month, depending on how much care a person actually needs. There's one type of facility that is a little bit different than what I just showed you and what we're going to, which is skilled nursing care. And that's called a continuing care retirement community. You might have heard about this kind of communities where you buy in. You actually buy a unit there, and then you pay a monthly fee. The difference between this type of facility and the ones we just were looking at is that you have to be healthy, and for the most part wealthy, to buy into these types of facilities. So you're literally moving in there. They won't let you move in if you need care or the handwriting is on the wall because you have an illness where it's quite clearly you're going to need care soon. And it provides a continuum from independent living, where you're in your unit, you don't need any care at all, you just utilize the common dining room and the pool or what have you, through assisted living, and then on to skilled nursing. One of the things to check out with that, if you're thinking about it, is if you're in independent living and you suddenly need assisted living, and that's what you're going to need going forward, will they allow you to stay in your unit and the care comes into you, or will you have to move to a different room? Facilities are all over the board with that. Now, when you get to the point where you do need skilled nursing, medical attention, then you would go to the nursing section of the CCRC. When these started a while back, over 2 decades ago, 3 decades ago, you bought in and you didn't get anything back when you died. That's changed a lot. So now they have a couple of different options. Usually you might get 80% back of your buy-in fee or 100% back that goes to your estate. So if you're thinking about something like that, really check out what those fees are. Again, make sure you understand you have to move in, you have to buy before you need care, can't buy after, and check the contracts. Now, a lump sum buy-in could be anywhere from 100,000 to $1 million. It really is going to depend on the facility and the size of the unit that you're getting and all the amenities that you want. Monthly fees could average around $6,500, but they certainly could be less or more. It just really depends. You might have heard of this website, seniorly.com. It's a good resource for people who are thinking about their next step, leaving home and going to one of these types of facilities. So I highly recommend, if this is something that affects you or anyone in your family, check out seniorly.com. The annoying thing about it is you can find a lot of facilities, but they don't really give you the rates. You kind of have to fill something out to get the rates, or at that point you could call the facility and ask them. And Seniorly is really designed to help you find your next place to live, and they get paid if you work with them and they actually place you in a facility. Then the facility pays them money, so nothing comes out of your pocket. Now we have the dreaded skilled nursing facility. So a skilled nursing facility is more like a hospital wing for people who don't need a total amount of medical stuff. It's not having a current operation or anything. It's 24/7. There's a nurse on site. Again, meals and medication are administered. Only a small percentage of those needing custodial long-term care are going to receive it in what we call a SNF. Usually a person in this type of facility, they're going to be there because they're in short-term rehab or they're ongoing skilled care, or they financially qualify for a Medi-Cal. So Medicaid is a low-income program, and Medi-Cal is what we call it in California. Costs for skilled nursing facilities, as well as everything else we've talked about, depend tremendously on the type of care that's needed. So San Francisco averages around $15,000 a month. So how will I pay for long-term care? You must be thinking that. First of all, health insurance and Medicare don't cover it. The most that your Medicare and also your private health insurance, if you're not on Medicare, is going to cover is 100 days of skilled nursing care if you need medical attention. So if all that's wrong with you, if you have Alzheimer's, that's not skilled care that you need. So Medicare does not cover even day one. But let's say that you had an operation, you got out of the hospital, they put you into a skilled nursing facility, you needed medical attention for 60 days, then your insurance plan would cover that. There may be a deductible that depends on the plan you have, but in general, that's the type of thing it covers. Now, you might go home and still need medical attention, a visiting nurse, and in which case they would still count that as part of the 100 days. And while you're having a visiting nurse, they would also have a aide come over and maybe give you a bath twice a week. But the aide is not cooking you meals. The aide is not taking you for a walk, that sort of thing. So it's 100 days per episode, per benefit period. So you might have a need now, you get all better, 5 years later, something else comes up, starts again. Another option for paying for long-term care is just to pay it all yourself. So if you're extremely wealthy and it's fine, and you just, no matter what the costs are, it's going to be fine. You don't need to leave those assets. Then self-insuring is a great way to go. Qualifying for Medi-Cal in California. So Medi-Cal, again, is low income. And it's kind of very interesting what's going on with Medi-Cal. I'm going to jump forward. So Medi-Cal, go down to the bottom of this, if I can show you with my cursor, which I'm not sure I can, but down at the bottom where you see where it says before July 2022, in order for you to get on Medi-Cal, you could only have $2,000 or less in cash and other non-exempt assets, a home being exempt, your one car being exempt, IRAs being exempt. So there's a variety of exemptions, but it's $2,000, made it very hard for people. July 1st, they changed that to $130,000. And for each additional household member, they add on another $65,000. And beginning in January of 2024, it will be unlimited. So you technically could have $1 million in assets and still get on Medi-Cal. What would that really mean, though? Medi-Cal doesn't cover assisted living, residential care, memory care, CCRC care. It's meant for you to be in a skilled nursing facility, which if you've ever gone into a skilled nursing facility, you may think like I do, that's not really how you want to spend your last years, but it's there for people who can't afford to do something else. Also, it will cover some amount of home care. It's limited, it's not around the clock. And also every county has its own types of programs, but it's there. And then what hasn't changed with the Medi-Cal program is Medi-Cal is still going to look at your income level. So if you're very wealthy and you have a high income, you're going to pay a high share of costs. So it's probably really, why would you even get on it? So a share of costs means, first of all, if you have a net income of under $1,564, you won't have a share of cost. But anything above that, you pay the lion's share of the nursing home and they supplement it. For example, a 65-year-old single person who has a gross income of $1,600 does have to pay, in this example I saw, $980 share of costs. And also, once you pass away, the state may come to get your assets. But I would appreciate it if you'd all take a look at the Canner website, which there's no link right here, but if you look in the top right corner of this fact sheet, you'll see CANHR. Just Google it. You find all kinds of things. It is California Organization for Nursing Home Reform, and they've got a lot of great information there. Now, let me go backwards now. Okay. Buying into community care retirement, we've already talked about that. Depending on family and friends, I have very little to say on that. That's something you have to think about. And then we have getting an insurance policy that covers long-term care. So a lot of people, when I talk to them about long-term care, they say, well, I don't know if I'm going to need it. That's really not the question. We know a huge amount of people will need some amount of care. The question that you actually have to ask yourself is, if you do need long-term care, how are you going to pay for it? And if you don't plan for the care, what's going to happen? What's going to happen to your finances? What's going to happen to your estate? How about your spouse, your family, your choices? By the way, I'd like to put in a quick plug here for estate planning, because estate planning can really help you with some of these issues here, both in terms of Medi-Cal asset protection and financial decisions to your estate. I strongly recommend people have a good estate plan. If any of you out there don't have one and you want a referral, I'm happy to do that. Just let me know. So how does long-term care insurance work? First of all, there's 3 types of insurance that would help pay for long-term care. The first is traditional. The second is a hybrid plan, which is a combination of either life insurance and long-term care or annuity and long-term care. And the third is life insurance with an accelerated benefit for long-term care. This type of product is not popular. I'm not really going to discuss it. If you have questions about it that you want to reach out to me later, I can certainly answer. But with this kind of product, the rider cannot be added on after the policy is taken out. Most people are going to be taking out, straightforward life, whole life insurance because they need a death benefit for any number of reasons. That's the most important thing to them, is a death benefit. So if you have a plan like that and it doesn't have long-term care rider on it, you can't add it. If you are just in the process of taking out long-term care insurance and you really just want it for long-term care, if you're in the process of taking out life insurance and you really want it just for life insurance, I would recommend doing something different for long-term care, because when you die, you won't have those benefits. And if you use those benefits up, it will take away from the death benefit. Also, long-term care benefits on a life insurance plan are not as robust as what they are on the traditional and the hybrid plans. So let's look at the pros and cons between the two types. So traditional long-term care insurance has been around since the 70s, I believe. And it is sort of a use it or lose it. That's how it has been. So you're going to pay a premium. If you never need care, you're not going to get anything but the unused portion of that year's premium back. It does provide, though, more bang for the buck on pure risk of long-term care. So if you don't have any family, you don't need to leave anything to anybody, you don't care if the money, if there's no benefit to you or your estate, you might look at that type of plan. It does have less expensive rates, and that can be important. However, the flip side, the con side, is premiums can increase, and they do increase. It has to be approved by the Department of Insurance. So an insurance company can't just decide, I'm going to raise rates 10%, 20%, 100%, whatever. They have to run that through the Department of Insurance. They have to show good reason. The good reason is not that the insurance company wants to make more profit. It is that they've had excess claims, more than they thought they would, a variety of other reasons. They have to keep a certain reserve, that sort of thing. There is no true death benefit on a traditional plan. These days, you might have a company that will, if you purchase the rider, it may give you a return of premiums or give your estate a return of premiums on your death. But it's not like life insurance. We're going to have a big lump sum. And one of the odd things about this kind of plan is it has the strictest underwriting. So if you have some, kind of significant health issues, you may not be able to get this plan, but you may be able to get number 2 down below. Number 2 are hybrids, life or annuity with long-term care. So the base is either life insurance or an annuity product with long-term care on it. The life insurance is easier underwriting than the traditional, and the annuity is the easiest, easier than all of them. With either of these plans, there's always going to be a benefit. If it's not used up to the insured on long-term care, then either the death benefit portion or the annuity benefit portion minus how much is paid for your care would be returned to their heirs after they die. Great thing, though, is premiums can never increase. So whatever you take out, that's what it costs. With a life long-term care plan, you can do a one-time premium, you can do a 10-pay premium or somewhere in between it. Some plans will do a 20-pay, and some plans will do, and most plans will do like an annual, something like that. Premiums will be more expensive, though, than the traditional plans. But again, remember, they can't increase, and you always know you're going to get a benefit for it. Annuity is the one where you have to pay in full in one payment. This is what these plans share. They share the same way of triggering the benefits. So these are all what we call tax qualified plans. So it's a government qualification on how the benefits are triggered. And it's either severe cognitive impairment or help with at least 2 out of 6 activities of daily living for at least 90 days. That help can be hands-on or just standing by you, making sure you're not falling over, just being there. And those 6 daily activities are bathing, dressing, toileting, continence, transferring, and eating. Let me just say this about that in case you're confused about any of them. Eating is not cooking. It is shoving food into your mouth. It is the last thing that we lose, as it was the first thing that we gained when we were a baby. Bathing usually tends to be one of the very first things that we lose, as that was the last thing we learned to do as a baby. So all plans have an elimination period. That's like a waiting period before the benefits begin. So let's say you start to receive home care and you're filing a claim with the insurance company, they approve you, but your elimination period is 90 days. It means that they will not reimburse you for that first 90 days. And then it will start on day 91. All plans have either a daily or a monthly maximum benefit. So if you set your plan up to be $8,000 a month, that is your monthly maximum benefit. Your finite total pool of benefits or lifetime benefits is designed by looking at how long you want the benefits to last. How long what am I comfortable with? So you might have a plan that gives you around 4 years of care or around an unlimited amount of care, really depending on how you set it up. Both the daily or maximum, as well as the total pool of money, can grow with inflation if that's how you set the plan up. When I first started in the industry, which was a long time ago, the average was people took out 5% compound inflation. Now it's closer to 3%, just because the costs are kind of high. And a lot of people who take out long-term care insurance these days they're not looking for a plan that's going to cover 100% of all expenses. They're looking for a strong base insurance product that if they need more, they can work with it from their income or their asset stream. Shared feature also is that there's shared options for couples. So you might have a plan where either they're both on the same plan and they just share a pool of money or an unlimited amount of benefits. Or in other words, if you have the $8,000 a month, they always each have $8,000 a month, but then it depends on how big the pool of benefit is. Or you might have them with two different plans, but if you take that option and one dies, the other one can get their benefits. Or if one runs out of money, they can go into their partners. Or the other option is that you each have a pool of money and then there's a third pool of money that they can both use. And this is some very good news for those of us in California, which is policies approved for sale in California must cover independent providers for personal care and homemaker services. They can't be family members, but you are not required to go through an agency. So that could be a way of saving money. So another thing to consider is that you might have tax deductions from long-term care insurance. And this is a couple of sheets that show you what is possible. Notice the top line says if you're an individual taxpayer who does not itemize, there is no deduction. So if you're just a regular person, you're not itemizing health insurance, and then forget it. But if you're an individual taxpayer who does itemize your medical deductions, you can look in the chart that's there and see for what your age is now, how much of the premium could you write off, could be included in with your eligible long-term care, with your eligible health. And then also the next one down tells you HSAs, HRAs, and MSAs. You can pay for long-term care insurance with those. So that can be super helpful as well. And that money doesn't have to get taxed at all that way. Skip the employee because it's really doesn't do much. And the C corporation is treated as an employee. But this is a big one. If you're self-employed, either as a sole proprietor, partner of an S corp, something like that, you also can deduct using that same chart. So I think that's a really good thing to know. Now, should you consider long-term care insurance? If you're financially comfortable now, or you will be in retirement, and you have at least a couple $100,000 in assets, not including your home, and you don't want to be at risk of self-insuring, then yes. What do I mean by financially comfortable and 200,000? Basically, if it looks as though you really are struggling or you're going to be struggling to make ends meet, you don't want to take out another bill, and long-term care insurance bills can be rather large. Also, if you're going to take out traditional long-term care insurance, you need to really grasp the fact that rates can increase. There are some plans where you can do a 10 pay. So I always encourage my clients to at least consider a 10 pay. So that what that means is rather than paying those traditional plans every year, paying a premium, and maybe you're 50 now and you might not need this till you're 90, it could happen that you have a rate increase in that time period. You pay it all off in 10 years. Obviously the premiums are higher, but it's just paid off, and then unlikely in the first 10 years you'd have a rate increase, and now you're just fine. And all of my clients who have done that have been very happy because they've been paying it off, they've paid it off. If you're healthy or relatively healthy and you don't have a health condition that is severe enough to preclude you from getting long-term care, then yes. And I can answer those health questions, but that's not something that would do publicly. I guess you can ask and I can give you an idea, but yeah. If you're wealthy, but you're looking for a smarter way to self-insure, then yes. I have a lot of clients that, you know, are multimillionaires plus their home. They have a lot of assets, but they have use for those assets. They've decided what they want to do with those assets. It might be putting their grandkids through college, or, you know, leaving a huge trust to somebody, or just having it be a smarter way. And a lot of wealthy people will also consider using a hybrid plan because they know that they're always going to get something back out of it. So yes, they put in a good chunk of money into a long-term care plan, but if they don't need long-term care, that's going to go to their family. And that's really important. If it's important for you to leave your status plan and you don't want to go through your own assets, then yes, you should consider long-term care insurance. And if you're between your 40s through your 70s, it's good to take a look at it. Most companies are not going to cover you after 79, maybe 80. If you have a cash value in a life insurance, a whole life insurance, or an annuity policy, and you want to exchange it for long-term care insurance, there's something called the 1035 exchange. This is an excellent way to get long-term care insurance. You might have taken out a whole life policy a long time ago, and your needs for that policy, you don't have it anymore. The home is paid for. The kids are done with college, they're on their own. And so what you can do is, if you take first of all, if you take your cash value from a life insurance policy that's grown, you're going to have to pay tax on that growth. But what you can do in a 1035 exchange is you can take that cash value, exchange it for a long-term care policy, a hybrid policy, something like that, and then you pay no tax on that. And also, when you start to receive your long-term care benefits, you don't pay tax on the benefits either. So it's a really good way to do it, either with life insurance or an annuity. This sheet here just, again, talks more about 1035 exchanges. I can send that over to Twin, and she can send you this sheet as well. But basically, it just says the kind of things. It has to be a like for like. So whatever you have it in, whatever name you have it in, it has to go over into the insurance under the same name. And let's see. So we're going to go to the questions. I think I did that a lot quicker than I ever normally do. It's a little challenging not seeing faces, I have to say. So this last sheet here just is telling you how you can get more information. Quotes. Oh, you know what? I'm going to give you some quotes right now because I know someone's going to ask, what does this cost? So let's look at that really quickly. So an annuity. There's one company out there that's the easiest policy to get. So if you have a lot of health issues, you might be able to get this policy, and it's really straightforward. For every dollar you fund it with, and remember with an annuity, you have to fund it all up front, with every dollar you fund it with, you'll either have $2 or $3 available for long-term care. So let me show you, or let me talk you through this. So let's say you have a couple, and with this one, it's really any age, and they want to put $200,000 into a annuity long-term care plan. They might have the cash to pay for it. They might pay for it with a 1035 exchange. If they both are in good enough health to get a plan, they put 200,000 into it, they'd have 400,000 available for long-term care. And if they're in, yes, really good health, they really can answer no to this simple questionnaire, then for 200,000, they'd have 600,000 available to share for long-term care, with each of them having close to $8,500 a month of benefit. That quote does not take into consideration growing with inflation. If it grows with inflation, everything is a little bit less. But that is my go-to type of plan if someone has significant health issues and really can't get anything else. It's just that it's a lot of money to fund upfront. So another option would be just traditional long-term care insurance. So let me give you a real-time quote for a female, single, good health who's 55 years old. And she wants a plan that's going to give her at least 4 years of care and at least $8,000 a month of benefit. An $8,000 a month of benefit times the number of months in 4 years gives us $384,000. If she uses the full monthly benefit every single month, her plan will be exhausted in 4 years. If she uses less, it will last longer. If she only uses $4,000 a month, it will last her 8 years. And then I added on 3% compound inflation because she's only 55, and I'm concerned that, the cost of care going up. So we're going to add on 3%. That plan will cost her $8,048 a year. Does include automatically in it, there's a 25% cash benefit. What does that mean? $8,000 a month, 25% is $2,000. If she just wants a couple thousand and she just wants to get a cash benefit, not have to show receipts, not have to go through all that, just give me a check every month for $2,000. The Mutual of Omaha plan has that. That's a unique feature of their plan. Now, a male will pay much less than a female for traditional plans. So a male the same age, everything the same, instead of paying $8,048, we'll pay $4,540. The reason why is that men have a lower risk of needing long-term care. Women have a higher risk of needing long-term care, of needing it for longer than men, of being alone when they need it. Men have a higher risk of dying young, so that's why they pay more for life insurance. Another illustration would be a different traditional plan where you have a couple that's on the same plan with some type of a shared benefit. And I tried to use the same figures. So mostly talking about a plan that give you about $8,000 a month for each of the people in the couple, and a pool of money each for around $390,000. But then it adds on an additional pool of money that you can both utilize. And for that, a couple is 55 and in great health, that premium is only $7,850. There's differences. You get a spousal discount. There's a couple other differences in it, but that kind of gives you an idea. And then the last one I want to share with you would be a life insurance with the long-term care rider. And I'm using a company called One America. And I'm going to, again, use a single female. And she, again, wants $8,000 a month of benefit and $4,000, around $400,000 total for long-term care. She pays $5,673 a year in an annual premium that can never go up. And if she doesn't need any long-term care, $200,000 goes to her estate as a tax-free death benefit. If she needs long-term care, she'll start to utilize through that death benefit. And if she finishes the death benefit, she still has another $200,000 of long-term care to go through. So that plan does not have inflation protection on it. It's something that can be added, but that just gives you an idea. If you had a joint plan with everything I just showed you, but two people on it, instead of it being $56.73, it would be $71.93. So it's not a huge amount more to have a second person on the plan. And then let's say that you were a couple who's 55, or a regular couple who wants $8,000 a month, but they want a really good plan. They want a plan that's never going to run out of benefits for either one. They want it, at least a portion of it, to grow at 3% compounded. They have a death benefit now of $266,667. That would be on the last to die, and an annual premium of $16,432. So you can see there's a lot of differences in how the plans work and what the premiums are. And when I work with people, the first thing that I will talk with them about is, how's your health? Because I need to know what plan might be the most appropriate thing. Also, by the way, if you do want to talk to me about long-term care insurance and get quotes, I don't charge for that. So don't worry about that. It's my pleasure to do it. If it turns out you do end up wanting long-term care insurance and you take out a plan, I get paid by an insurance company. All of the commissions are exactly the same for anyone doing it. So it's just really my pleasure to be able to educate you on long-term care insurance, and want to make sure that I answer all of your questions.
No worries about that. All right, so Lee, we have these questions here that I think some of them were already answered during your presentation, but I hope you don't mind reiterating some of them so that our participants who came in a little bit later can get an idea. All right, so one of the first questions is, how does long-term care insurance work if you are not a US citizen?
That can be challenging. If you have a green card, you should be okay getting the insurance. But my concern is that if you're not a US citizen, I always ask, are you planning on staying in the country? Because most policies will not cover you outside of the US, with only a couple of exceptions. Okay, this is what we're working on here, practically speaking. When somebody's too old to buy, you're too old to buy long-term care insurance if you need long-term care, or if you have a health issue by which you will be uninsurable. But in terms of an age, a number, the hybrid that I showed you first can go to age 80. So actually that hybrid, a hybrid could be really good if you're older and you can fund something like that. So I would say above 80, probably a no-go. There might be a company that takes someone who's 81 or 82, but that would be about it. And basically you're too old to get it if you can't get it. So that's the reason that people take it young. There's a lot of reasons that people will take long-term care insurance at a young age. There's a cost in waiting because the premiums get larger, and also you get older. So the cost will be more expensive because you're older. And also if your health changes, you won't be able to get it. Health underwriting is a big deal. All policies are health underwritten. So that's why you want to get it as young as possible. And also it's great for risk tolerance, because if you take out long-term care insurance, not towards the end of your life, but in the middle of your life, it might allow you to be more risk adverse in your investments, because you don't need to count on them for long-term care. So I would say that the average of my clients these days taking out long-term care insurance is 45 to 65, somewhere in that range. But I have worked with someone just recently who was 80 and someone just recently who was 26.
Wow, thank you. I think that answer really directly relates to our next question here. What options are there if you don't plan things out in advance?
What options are there to pay for long-term care? Basically, you'll have to pay for it yourself until you want to get on Medi-Cal. If you run out of all your assets, if you run out of what we've seen earlier in the talk is that you can keep your assets and still get on Medi-Cal, but you'll have a share of cost to do so. And also, if you're on Medi-Cal, you would have to go to a skilled nursing facility. So I want you all to realize that the reason that we don't see a lot of elderly people on the streets is because they're on Medi-Cal and they find them places in facilities. So the option is simply that you're going to spend your own money. If you want care outside of a skilled nursing facility under Medi-Cal, you're going to have to spend your own money. So that's a big, that's the option that you face. Yeah.
I think that perfectly segues us to the next question here. More like asking for your comment on it regarding reimbursements they did not receive for their sister's long-term insurance, and they continue to pay into it.
Why would you get reimbursed from her insurance when she stopped working? Was it because she actually needed long-term care, or was it because she stopped working? So if it was because she stopped working, but she continued to pay into it, she doesn't get anything from the insurance company until she actually needs long-term care and she files a claim and is approved. It sounds like, if I read between the lines, that your sister has a group plan and she's paying into it, but she stopped working. So why is she paying into a group plan? Well, you just pay into a group plan for the rest of your life, basically, just like you pay into Medicare for the rest of your life. There isn't a time when you stop paying unless they had a plan that was like a 10 pay, which I don't think group plans did. If, on the other hand, your question is your sister didn't get reimbursed for the long-term care that she's been receiving, that's a completely different question. And maybe you could write something in the chat and let me know which it is. And if that's what it is, then I can talk to you about that.
Thank you, Lee. We're nearing the end of the questions we have from the registration here, but I'd like to encourage people to unmute themselves, or by raising their hand and letting me know, to unmute you on my end, and so that you can unmute yourself, join the discussion live with us while we answer the next couple of questions. Please consider joining us for the live discussion. The next question, and feel free to reshare your screen, Lee, but the next question is, what are the different options for long-term care? This person's parents are really worried they might end up paying $15,000 a month for
let's see. Do you want to do this last question and then I'll go back to my presentation, because we only have one last one?
Absolutely. So this next question here is just regarding guidance about how and whom to hire for help at home, and about a few hours a day.
Okay, so if this is a person who has long-term care insurance, the insurance company may be of a little bit of assistance. They're usually not a tremendous amount of assistance, but a lot of them will send out a care coordinator, and that care coordinator will be local and will give you like some tips on agencies who they like. I do that with my clients who, 20 years later are now needing care. I'll direct them to a couple agencies that I just like, I feel comfortable with. Other than that, it's kind of hit or miss as in anything. You could look and see what your local home health care agencies are, and then follow up and see, how they're rated and what people say about them. Or if you are just wanting to hire someone that's not with an agency, I always suggest to people, think about people who have needed care, their relatives have needed care, who have they used, maybe that person would do it. Maybe go to your local church, synagogue, what have you, your local senior center, your local community center. Maybe you're part of the Italian club, go there. I had a client who only wanted someone who spoke Italian, and, they were able to do it in an informal networking. I hope that works in terms of the guidance. You're certainly welcome to reach out to me and I can give you some additional ideas. Okay, so the question, what are the different options for long-term care? My parents are worried that being in a home will cost $15,000 a month. So let's look at this. Where you can get care, and you will get a copy of all of this, but there's basically 3 places to get care. Was that the question? Was where to get care, how to pay for care? Sorry, I blanked when my screen didn't come up. Remind me the question.
I will reread it right here. It's
a good thing I have long-term care insurance, I'm telling you, because the memory is not what it used to be.
The questions are, what are the different options for long-term care? This person is really worried for their parents who are concerned they might end up paying $15,000 a month for.
Right. So when this person says, what are the different options for long-term care? I'm just not sure if you mean where to get care or the different ways to pay for care. So if it's where to get care, it would be at home or in an assisted living, residential, memory care type of facility. It could be a continuing care retirement community that you have to buy into. Could be a skilled nursing facility. Most people start at home and then they kind of move around unless they want to go to buy into a continuing care retirement community. If you're talking about how that you will pay for that $15,000 a month, basically you're going to either have to pay for it yourself or themselves, or you're going to qualify for Medi-Cal, or just decide, because the rules are changing in Medi-Cal, that you will do a share of cost and go to a skilled nursing facility or have a little bit of care at home. You could buy into a continuing care retirement community where you buy in and then there's a monthly fee and it takes care of you. It can be 100,000 to $1 million to buy in. Depending on family and friends, you could get long-term care insurance. In terms of the long-term care insurance, there are basically, we're looking at 2 types of long-term care insurance, a traditional plan and a hybrid plan. And the traditional plan, you can see here the pros and cons of it. It could end up being able to pay the $15,000 a month, but most long-term care insurance is not designed to pay for 100% of every type of long-term care that could happen to you. But that being said, you could get something that's $15,000 a month. The traditional plans usually go up to about $10,000, maybe a little bit more. And the hybrid plans could go up really high. I've seen people take out $25,000. So those are the options for it. And if I didn't answer your question completely, please let me know.
I will be sure to include your email in the post-event email going out to all registrants, Lee, and I'm sure that if anybody has lingering questions, they'll let you know. There is a person who's raised their hand, Truman. Why don't you let us know what's on your mind?
Lee, what is the typical for long-term care insurance? How much does the insurance pay per day? Is there a certain limit that they'll pay?
Well, first of all, they're not going to pay more than what you were charged for a day. But secondarily, when you take a plan out, you design how much the maximum is to be reimbursed. So if you remember, I was talking about an $8,000 a month benefit. And so that would give you up to $8,000 a month. You throw in all the costs for that month for long-term care, and they will reimburse you for the cost of care, but no more than $8,000 that month. And if you had an infinite plan that would never run out, that you could just have that the rest of your life. Most plans are finite. So if you have a plan that was $8,000 a month reimbursement, and let's say I had it, let me go back to my illustration here so I get the numbers straight. Let's say you had $8,000 a month, and it was gonna pay you $8,000 a month, and you had a benefit of $600,000 total. Once you hit the 600,000, it's done. So it really depends on how much you take out and how much. So
yeah, I was calculating. I was looking at the 15,000 a month, and and if you just divide that by 30 days, if they need in-home care for 30 days, that's $500 a day. But if the insurance only pays a maximum of 8,000, you're going to be out $7,000 a month to pay for that, right?
Exactly. Yeah. So it's a question of how to plan how design your long-term care insurance.
Yeah, yeah. Is there such a plan that you can say, hey, I want my insurance to pay $500 a day? How much would that cost?
Well, it would cost a lot.
Yeah.
Yeah, I mean, it would cost a lot. I can't tell you right now how much it would cost, but it would cost about double what I was telling you before, because, you know, I was showing 8,000 a month and it's 15,000 a month. So let's change it to 16,000. It's kind of double what I told you before.
Okay.
So that's a great example of communicate with me. We can set up a time to talk. Doesn't cost you any money. I can run the numbers and I can tell you the answer to your question. And no matter what you do, it doesn't matter to me. You'll have an answer because it's very personalized. So I can run scenarios by you. I'm very, very happy to do that.
Yeah, because if you look at that, if it's $7,000 and you want it for 5 years, so call that 60 months, it's going to cost you $420,000 in 5 years.
Yeah.
And plus, what is that, $8,000 a month? No. How much was that policy? $8,000 a year?
That was $8,000 a year premium. Wait, was it? No, wait. Yeah, some of them was $8,000 a year.
Yeah,
7,000, 8,000.
Yeah, based upon that. Yeah.
Yeah. Yeah. So I mean, a $15,000 a year premium is kind of normal.
Yes.
You know, so it really depends. And then you would pivot on, okay, what's the most important thing to you? Well, the most important thing to you sounds like you want to have $15,000 a month, but maybe you don't need unlimited care. Maybe you don't need a plan that will never run out of benefits. So then you're going to pivot with how large the plan is. So you might end up with a plan that just gives you 4 years of care or 2 years of care or whatever, but you still have your 15,000. I mean, you can't have everything and pay very little for it with long-term care insurance. It's expensive.
Yeah.
But I can guide you with more than I can go through right now in a group situation. I absolutely can and tell you what it would cost you.
Okay. Excellent. Thank you so much.
You're welcome.
I wondered, actually, one thing, if you have any information on what kind of care might be available through the VA for veterans.
There is care through the VA. I'm not an expert on it. You can probably just Google that and get to the right source in 2 minutes. I do know this, that if you're a veteran, the priority is to ones who saw active service and are low income.
Okay.
So you have to qualify on those things.
Yeah.
But other than that, I don't have the particulars.
Thank you.
You're welcome.
Ryan.
Leah, I do have another question.
Yes, please, Truman, let us know.
Lee, does if a person is using in-home care, well, then you mentioned tax deduction. If that can you write that care off on your taxes?
Does this person have insurance or not have insurance?
No, it's a private pay.
It's a private pay.
So
Well, it would count as
they're
medical
fairly well
expense.
off. They are fairly well
Would
off.
count as medical expense, but that would be more like you would have to have something in writing with a social
So would you
security
get
number.
it from so that's why you'd probably want to go through an agency?
Well, an agency is great because it's all done and set in stone right there. And they can provide you what you need to be able to have that be a write-off.
I get
Or
it.
go
Okay.
under your health insurance, health deduction. I don't think it's impossible to have it with a private pay, but it's more challenging. You're gonna have someone coming over and then you got to get their social security number and you got to have them, some people don't
Even-
like that. But-
Yeah, well then probably, well then I could see that if you just hired somebody that maybe somebody else used and they say, hey, I use this person, and
Yeah.
maybe they aren't associated with a agency, but through
Right.
an agency, I would think that they would have that, wouldn't they?
That they would have what?
That they would have the ability to be able to give you everything in writing so that.
Oh, yeah, absolutely.
Yeah, okay.
Absolutely. You're gonna get a receipt. It's gonna tell you exactly what it was.
Yeah,
Yeah, that
Okay.
would count as a medical
cost, right?
deduction on your time.
Yeah,
Absolutely. That's a great question.
thank you.
Anyone else?
Joyce, we see your hands up, but you're on mute.
Yes, I just wanted to say, Lee, that you've done an excellent job explaining all this. I wish I would have heard this before. Because I do have long-term care, but I'm trying to determine if I want to keep it per se, so.
If you want to keep it.
Well, keep it or because they increased the premium, so.
Yeah, I know a lot about these rate increases. So if you want to talk with me about it, I'll give you my guidance on it.
Okay, I may want to, because I'm trying to determine what I should do. And they've given me other plans that I could take, but, I've always had lifetime care on it. And also,
You're talking about Genworth, right?
no, it's actually the state.
Oh, CalPERS,
Yeah.
CalPERS.
Yeah, the big lawsuit and nothing came of it. And it's.
Yeah, nothing came of it.
So much into it and then.
Yeah, it's very, very challenging for those of you who aren't aware of this. There's a state program, California CalPERS, Public Employees Retirement System. And their plans were always the least expensive out there and the easiest to get. And it's come back to bite them big time because they took on all kinds of risks and they didn't charge enough. And then they've been raising rates. And now they're just like trying to sell off their book of business. And
Really?
because they're like a special state entity, they don't have to go by the rules. The other insurance companies have to go through that California Life and Health Guarantee Association if they're in trouble, and CalPERS doesn't. And so far, CalPERS isn't.
Yeah, but what they offered was not really.
It's challenging. It's super challenging. They tried to get a settlement. They couldn't find anyone who would do it. So
True.
I feel you on that. I feel you on that.
Thank you. But your presentation was really excellent. So thank you.
Thank you for coming and for asking a question. I appreciate it.
I do have one more question for you, Lee.
Yeah, keep asking.
As you see your parents go through certain long-term issues of health and so forth as they do get older, what's the normal, not normal, there's really never normal, but what's a typical age that a child would consider doing long-term care, like say for an example, like you mentioned, CalPERS, but if it was you get CalPERS when I think that you start working for the county or whatever it is, but would it be pretty inexpensive for a 35-year-old to purchase long-term care insurance? And how long can you like some life insurances only go to 20 years. Is that the same kind of a situation with long-term care?
So with long-term care insurance, you can take it out pretty much most companies from your 30s through your 70s. So that's not the problem. And the younger you take it out, the less expensive it's going to be. And you'll also, if you're really young, want to put inflation protection on it. So the benefits are growing over time, since you may not need it for a very long time. So those are all options for you. The younger you take it out, the better it is. There's just no getting around that. If I'm talking to a 35-year-old, and if they want traditional long-term care insurance, which is going to be the least expensive way to go, and the issue is, you want me to give you a quote, and I can't because I don't know. I gave you a quote for a 55-year-old male at $8,000 a month and $384,000 in total at 3% compound. That was $4,500 a year. A 35-year-old male would be much less than that, but I can't tell you exactly what it would be. It would probably be closer to 3,000 or 2,500, if that makes sense.
Yeah.
So you want to get that out. You know, it's important. But if you take out a traditional plan, then I will probably suggest that people look at a plan that does a 10 pay, which means that you're completely paying off the premium in the first 10 years, so that you don't have to worry about rate increases down the road. Now, if that person taking it out at 35 can't afford a 10 pay, then that's not going to work. So in other words, let's say you're 35 and let's say you don't need care until you're 80. That's 45 years from now. You can either pay the premiums every year for 45 years, or you can pay every year for 10 years. The 10 years is much bigger amount than the 45 years, but the 45 years is a long time and rates could go up during that time. So it's just something to think about. If that was a 45-year-old who was taking out a hybrid plan, though, they would not have to worry about rates going up, because the rates can't go up with a hybrid plan, but they're more expensive. Does that make sense, Truman?
Yes, that does make sense. I was also thinking, is it better to just purchase like a universal life insurance that has a certain amount of money at the end of the policy, and you can take it in from there? But
That's life insurance.
yeah, but that's life insurance. Yeah. Okay.
So, yeah, I mean, it's, what is the risk here? You know, that's the question. What is my risk now? So when we're younger, our risk might be like life. It might be, I die, what happens to my children? What happens to my spouse? What happens to the, how does she pay off? How does he pay off? How do they pay off the home? So insurance can be very important. Even something like disability insurance is very important when you're young. You usually get it through your job. But if you become disabled, you know, that can be really challenging. And if you're in your 30s, you're probably more concerned about being disabled than about end of life things, long-term care things. But I agree with you that when we see our parents and our elders going through this, it's, you know, it's something. It starts to make you think, I need to take care of this. And especially if the parents haven't done anything to take care of it, and now, you know, the younger people are on the hook to try and figure out all of this, it's not good. And if the parents, a lot of parents have got long-term care insurance, and their kids always tell me what a blessing it was that they had it. I actually work with multi-generational families now, because their parents came to me, you know, 25, 30 years ago, and then the kids, they sent their kids. And I'm actually working with a person right now who took insurance out with me, but has two young sons, again, people in their 20s, and the parents want to buy them long-term care insurance now, and they want to be able to gift that through the, you know, how much you can gift a child tax-free. So it's really quite interesting. People are very creative, and
Yeah,
we're going to do a 10 pay because again, they're just too young. I don't want their rates to go up over time.
Thank you, Lee. We have one question here in the Q&A, and I'll read it out to you. This person has a traditional long-term care policy with lifetime benefits. If they were to change to a hybrid plan, will they be able to keep their lifetime benefits on the hybrid plan?
There's only one hybrid plan that will do lifetime benefits. And it's called One America. I mentioned a quote about that, and I work with them quite a lot. So if you were to give up your current plan now, and you're looking for a hybrid that does unlimited, that can happen. But of course, you'll have to pay for it, depending on the age that you are now. And, that may or may not be affordable at this time. I don't know, because I don't know how long you've had the lifetime benefits. If you just started this traditional long-term care plan, then it would be really great to look at it, a hybrid. If you've had it for 20 or 30 years, you'll probably be pretty shocked with the price difference. But either way, it's very, very easy for me to run you a quote. All you have to do is reach out to me. You can send me an email, you can call me on the phone, whatever, and get a little tiny bit more information from you. I can then just send you a quote and you'll see for yourself. Basically, the information that is needed to look at a policy is: what is your date of birth and how is your health? What are your health issues? So I know if it can be done or not. And then we look at other things like, are you a smoker, non-smoker? Some policies do look at your parents. Cognitive impairment can be an issue with a couple of companies. It isn't with the one I'm thinking of that would do the lifetime benefits, the hybrid. And then we look at, the type of benefits that you want to have, and then I can actually provide a quote for that. But I do have to know age. I do have to know health. And also perhaps you might be married or in a significant relationship. Is that person going to be involved? And then I can give you a quote.
Well,
So
we're nearing the end here.
one thing I just want to say about myself, in case you're wondering, is I don't do any other kind of insurance. I just do long-term care insurance. So I'm just like down in the minutia because the stuff changes all the time. I'm not one of those people that can sell you, you want disability insurance, you want life insurance, you want whole life, you want this or that. I just do long-term care insurance. So I work with a lot of financial advisors and estate planners to help them get their clients get this. It's usually like the last piece of the retirement puzzle that people are thinking about if they wait till they're older. Used to be the average age people took it out was 65 to 70. And now, like I say, it's a good 20 years less.
All right, I will let everyone go and have a wonderful rest of your week.
And
Bye.
thank you, Twin, very much. You're an excellent moderator.
I still feel like I can do better sometimes, but thank you.
All right, bye-bye.
Bye.